Hello everyone, in this module we study Chapter 12, Business Valuation. The learning objectives include understand the importance of business valuation, understand the importance of stock and bond valuation, learn to compute the value and yield to maturity of bond, learn to compute the value and expected yield on preferred stock and common stock. Learn to compute the value of a complete business. Bond valuation model. The value of the bond is the present value of the cash flows the investor expects to receive. What are the cash flows from a bond investment? There are three types of cash flows: amount paid to buy the bond, coupon interest payment made to the bondholders, repayment of par value at the end of the bond's life. Other factors include the bond's time to maturity and the discount rate. IBM Bond Information: the bond's name, coupon rate, maturity, and the closing price. We can draw a IBM bond timeline, compute the value for the IBM bond given that you require an 8% return on your investment. Six is 3.75% annual annuity for 5 years and 1,000 lump sum in 5 years. So the value of the bond equal to the present value of the annuity for 5 years, and the lump sum of that face value paid in 5 years. Also, you can use a financial calculator to get the same result. Most bonds pay interest semi-annually. Semi-annual coupon bond with 5 years to maturity, 9% annual coupon rate. Instead of 5 annual payment of $90, the bondholder receives 10 semi-annual payment of $45. And then compute the value of the bond given that you require a 10% return on your investment. Since interest is received every 6 months, we need to use semi-annual compounding. Yield to maturity. If yield to maturity is greater than coupon rate, bond sells at a discount. If yield to maturity is less than coupon rate, bond sells at a premium. Interest rate risk. Bond prices fluctuate over time. As interest rate in the economy change, recovery rates on bond will also change, resulting in changing market prices. Interest rate increases, bond price drops. Valuing preferred stock. Preferred stock price is the dividend divided by required rate of return. Valuing individual shares of common stock. The price is the present value of all expected in dividends discounted at the investor's required rate of return. Investors do not know the value of D1 and D2 and Dn. The future dividend must be estimated. Assume the dividends grow at a constant rate G%. So we can have the reduced form, which is the dividend at the end of the first year divided by required rate of return minus that G%. This requires K is greater than G. For example, what is the value of a share of common stock if the most recently paid dividend is 1.14 per share and the dividends are expected to grow at a rate of 7%? Assume that you require a rate of return 11% on this investment. We can use this constant growth dividend model to get a price 30.50%, $30.50. Value in total stocks holders equity. Use the free cash flow discount cash flow model. Free cash flow is the amount that is free to be distributed to debt holders, preferred stockholders, and common stockholders. Cash remaining after accounting for expenses, taxes, capital expenditures, and new net working capital. Calculating free cash flow. We can use different ways to calculate free cash flows. Typically, free cash flow is NOPAT plus depreciation plus amortization minus capital expenditures minus new net working capital. Calculating free cash flow. For example, ABC Company has the following financial information forecast before constant growth until year 2025. Terminal value. Forecasts free cash flows once company is expected to grow at a constant rate. For example, ABC Company has free cash flow of 6,400. The discount rate is 10%, and they are expected to have a constant growth rate of 5%. So the terminal value can be calculated. Yield or total return on common stock. What is the yield on stock when dividend is 8 cents? Dividend growth rate is 20%, and the current price is $28.875.